Welcome to the latest Motley Fool scoreboard. I'm on in Chockabaloon. We've got longtime fools, Jason Hall and Matt Frankel, giving a 1 to 10 rating to cybersecurity company Zscaler, ticker symbol ZS. Rate the strength of Zscaler's business, including factors like industry and competition. Lots of competition out there. A 10 is invincible. A 1 is hopeless. Jason's at a 7. Matt, you're at an 8.
Yeah, there's a massive need to do what Zscaler does. I mean, honestly, to be on this recording, I had to log into Zscaler to get what I needed. There's not that much direct competition. What I mean by that is a lot of there's a lot of cybersecurity companies like CrowdStrike is often thought of as a big competitor to Zscaler, but they actually solve two different problems. One controls endpoints, one detects threats, and they actually partner to share information, which makes both platforms inherently stronger. Zscaler is used by nearly half of the Fortune 500, and there's a reason for it.
Yeah, and I agree with Matt. The reason I went with a 7, though, is that despite agreeing, and also the fact that there are incredibly durable tailwinds, it's a super important business, like Matt talked about. Earns the great margins that it does, 27% free cash flow margins. All of those things are true. But I think its moats are probably less secure than people think. Tech requires constant innovation or you will lose your edge. And I think one of the things that proves this out across the tech world is we think about compensation. Free cash flow just surpassed stock-based compensation last year. Again, a company that earns 27% free cash flow margins, its free cash flow just surpassed how much money it gives out in stock-based compensation. So a significant amount of future cash flows are going to be needed just to reduce dilution. And here's a crazy thing. Over the past 4 quarters, stock-based compensation actually grew faster than free cash flow.
That's not a good trend. For management, a 10 is Warren Buffett, a 1 is Homer Simpson. Jason's at an 8. Matt, you're at a 9.
I'm saying a 9 at risk of losing my title as stock-based compensation police around here, because that is a trend worth watching. I don't mind stock-based comp when a business is doing really well, but that does seem excessive. It's led by its co-founder, Jay Chaudhry. He's been CEO for almost 2 decades since he founded the company. He still owns almost 18% of it. And it's not just him, other executives have $250 million of their wealth invested in Zscaler. And more with all this stock-based comp they're getting. He's delivered incredible performance for investors, though. 800% total return since the 2018 IPO. So it's really hard to argue with his leadership. And other leaders are really impressive. There's several tech CEOs on the board. This chief technical officer used to be a Salesforce exec, and I could go on, but it's an impressive team.
Yeah, I came in at 8. 9 is, I think you have to reserve for very, very, very few rare leaders, but he is proving to be that rare founder CEO who can make that transition from running the startup to still delivering when the company is public. Here's the reasons I can't go higher than an 8. Despite the enormous growth, insiders continue to earn a bigger piece of the pie via stock-based compensation. And this is a company that's not profitable and not just on a GAAP net income basis. The company has never had a single quarter where it's generated positive operating income, right? I can't ignore those things and award a wonderful CEO with something higher when the business at the scale that it's at is still not reporting even positive operating income.
Jason is the stock-based comp sheriff today.
For financials, a 10 is a fortress, a 1 is yikes. Jason's at a 7.5. Matt, you're at a 9 again.
Yeah, and I mean, like I said, I'll leave it to Jason to talk about the stock-based comp. But I mean, if you're increasing the share count by a few percent per year, but you're delivering 20 to 30% returns for shareholders, there's only so mad you can be about that. I was more mad in 2022 when these were all falling and this was still happening. But I gave it a 9 because they have about $2 billion in net cash on the balance sheet. So even though they don't have positive operating income, they have plenty of runway to keep their growth story going. 43% revenue growth rate over the past 3 years. This is a rule of 40 company and more. They have they grew revenue by 24% over the past 12 months and had a 28% free cash flow margin. Add those up and you get a pretty impressive number. Gross margin is over 80%. So, I mean, just on profitability, it scores pretty high.
Yeah. So again, I definitely do sound like the stock-based comp police, but just some more metrics to kind of lay this out that I think are important. Number one, I agree the balance sheet is extraordinarily strong and getting stronger because they are pumping out more and more, 600, almost $700 million in free cash flow over the past 4 quarters. But just some context. Since the IPO, when companies go public to sell a bunch of stock to raise money, since they did that, the share count has increased by about 32%. That's a tremendous amount. And they're still adding between 2 and 3% a year to the float. Again, I know I'm beating the drum a lot. I know tech talent compensation means stock-based comp, but the numbers are getting bigger, not smaller. That's notable. Again, it would take 90% of free cash flow just to keep the share count from growing at this point. Now, can it accelerate free cash flow at a faster rate? If you can do that and start buying back shares quickly enough to reduce dilution and then continue growing free cash flow from there, then maybe I'm scoring it a little bit on the low side, but prove it to me.
All right, well, let's put that stock-based compensation into the valuation, Jason. How well will Zscaler stock do over the next 5 years? How safe is it? 10's a sure thing. 1's a lottery ticket.
I think it's going to make investors money between 5 and 10%. And there's a very good chance it's on the higher end of that, maybe even higher. Safety score of 6. A couple reasons why here. Growth rates are slowing, but gross margins have actually compressed a little bit over the past couple of years. And I've talked about it already, but I think its moats are less secure than most bulls would believe. And a lot of times the thesis just boils down to, well, because cybersecurity. I mean, don't get me wrong. This is an extraordinarily good business that I like, and I have owned it in the past. I could see myself owning it again. But I believe the combination of slowing growth, an incredibly rich valuation of over 16 times sales, it's way above the average over the past 3 or 4 years, plus the impact of that stock-based compensation. They line it up to be a fine investment, but maybe not extraordinary stock to own over the next 5 years if today's price is where you're starting.
Yeah, I said a 10 to 15% range, but we're probably closer than it would seem. Like I would be at the low end of that range. The company's at nearly an all-time high. It's at about 17 times sales. I do believe Zscaler, and here's where I got the 10 to 15. I believe Zscaler is going to grow its earnings, or grow revenue rather, at a 15 to 20% annualized rate over the next 5 years. I think we'll see some multiple compression, and that's where I kind of reduced it to a 10 to 15% range. It does have a leading position in zero trust endpoint security, and it's impressive that I mentioned half of the Fortune 500. So that gives it some margin of safety, I believe.
Let's move on to everyone's favorite topic. Jason, is there a company in Zscaler space you like better?
This is where I talk out of both sides of my mouth. I just spent the past 6.5 minutes beating up Zscaler largely because of the impact of stock-based compensation on investor returns going forward. So I'll throw in SentinelOne. I think it's one of the more interesting cybersecurity stocks you could buy right now. Yes, like Zscaler and CrowdStrike too, which I own, it pays an egregious amount of stock-based compensation as a percentage of revenue. It's a lot higher than Zscaler, but it trades for 7 times sales. And there's indications that its growth rates are actually about to accelerate. I think on a risk-reward basis, it's far more compelling than anything else I'm seeing out there in cybersecurity.
So for me, just speaking about the growth stories of their business, Zscaler and CrowdStrike are in a class by themselves.
Agreed.
And of the two, I do have a slight preference for Zscaler.
Also agreed.
Thank you to both Matt and to Jason. They've given Zscaler a pretty strong overall score of 7.4 out of 10. Look out for a new scoreboard every market day at 7 p.m. Eastern. Next up is Lowe's. Till then, full on. I've heard you talk a lot about your that you're the stock-based compensation police. Was that a self-appointed role? Was there an election?
No.
Is it a task force?